Hi everyone, today we're tackling accounts receivable, a critical area for businesses that sell on credit. We'll break down the key processes, identify control activities, and discuss risks of material misstatement. First, let's understand what accounts receivable is all about. When a business sells goods or services on credit, the customer takes the product now but pays later. This creates an account receivable, a promise to pay. The process starts with granting credit. Who gets credit? How much? What are the repayment terms? These decisions need proper approval and documentation. Let's start with granting credit. This is where the business decides which customers can buy on credit and sets limits. For example, a customer might be approved for up to $10,000 in credit with 30-day payment terms. This process needs strong controls to prevent unauthorized credit approvals. Once a sale is made, journal entries need to be accurate and properly recorded. Next, businesses usually send out monthly statements to customers. These statements list all transactions, amounts due, and payment terms. For example, a customer might have 30 days to pay with a 2% discount if they pay within 10 days. These terms need to be clearly communicated and approved by management. Now, let's talk about receiving payments. Payments can come in as cash, checks, or direct deposits. Each method requires different controls. For example, cash needs to be handled carefully to prevent theft, while checks need to be deposited promptly. Direct deposits should go straight into the company's bank account. One of the biggest challenges in accounts receivable is managing overdue accounts. Businesses need a clear process for chasing late payments. This might include phone calls, emails, or even sending accounts to a debt collection agency. A common tool for tracking overdue accounts is the aged debtors schedule, which categorizes debts by how long they've been outstanding. If a debt becomes uncollectible, it may need to be written off as a bad debt expense. This requires proper approval and documentation. Now, let's talk about internal controls. These are processes designed to prevent errors and fraud. For accounts receivable, key controls include credit approval, segregation of duties, reconciliation, and monitoring an aged debtor schedule. Finally, businesses should regularly monitor their accounts receivable performance. This includes calculating key ratios like accounts receivable turnover and days in receivables. These metrics help assess how efficiently the business is collecting payments. Trends in these ratios can signal potential issues, like customers taking longer to pay. That's it for this video. We've covered the key processes, controls, and risks in accounts receivable. Thanks for watching.